Welcome back to NYC Market Moves. Buckle up, we're breaking down the wild ride of the US stock market over the past 2 weeks. Why it soared, why it pulled back, and what might happen next. It's been a story of two distinct halves. The US market went from a steady, confident climb to a sharp pullback. The pivot point came around December 2nd. The Dow, the Nasdaq, and the S&P 500 all saw their winning streaks come to an end. The Dow saw its largest drop, falling about 427 points. This ended a strong 5-day rally. Since then, the major indices have traded sideways and weak, with their momentum clearly disappearing. So what drove that initial rally? 3 key factors. First, aggressive expectations for rate cuts. Weak jobs data led investors to believe the Fed might cut rates sooner than expected, which ignited a rally in growth stocks. Second, the unstoppable momentum in tech and AI. AI-related stocks continued to attract huge inflows of capital, keeping the Nasdaq strong. Third, year-end positioning, with institutional funds already setting up for 2026. But after December 2nd, the market's tone shifted. 4 forces began to weigh on the market. First, profit-taking after the significant rally. Second, pre-Fed meeting jitters, with investors pausing their moves, awaiting guidance on rate cuts. Third, rising treasury yields. This put pressure on long-duration tech and other high-valuation stocks. And fourth, mixed economic data. A combination of weak jobs data and sticky inflation made investors uneasy about the soft landing narrative. Now let's look at sector performance. Tech and AI were the top performers, supported by confidence in their long-term growth. The energy and financial sectors pulled back due to fluctuations in bond yields and oil prices. Heading into the holiday season, consumer stocks showed mixed performance. But the weakest performers were, without a doubt, small-cap stocks, reflecting deeper market concerns about economic weakness. Looking ahead, the next 2 weeks are absolutely critical. Several key variables will determine the market's direction. The Fed's interest rate decision is the number one factor. If they cut, the market could break out. If they don't, volatility could intensify. Next up are inflation and jobs data. The market needs to see inflation cooling without the economy slowing down too much. Then there are treasury yields and the direction of the US dollar. They will trigger huge capital flows. Finally, there's the year-end fund flow, as institutions will be repositioning their portfolios. So, what should investors do now? Stay cautious. First, maintain balance. Now is not the time to go all in. Second, use any pullbacks to add to high-conviction positions in leading tech and AI stocks. Third, look at defensive sectors like healthcare and staples as a hedge. And fourth, keep a close eye on the Fed. Their next meeting will set the tone for the start of 2024. Thanks for watching. This is NYC Market Moves. If you want sharp, actionable insights into the US market, be sure to subscribe. We'll see you tomorrow.